Let's kickstart the first conversation of the day. And joining me now to talk about making sense of the markets in 2022 and what you need to bear in mind is Santosh Navlani, who is the Chief Operating Officer of ET Money. Thanks so much, Santosh, for taking the time. Good evening to you. Now, this is a study that you have undertaken at ET Money, and you've looked at various facets of what has played out in the markets so far. But just to set the context, where are we at right now? I don't think a lot of people had anticipated this big up move that you saw in the last couple of weeks particularly, but over the last month or so in the equity markets here in India. So where do we stand right now?
Yeah, Alex, I wish I can say confidently where do we stand right now. I think what we're trying to do is making sense of what is happening across the globe and what exactly is Indian markets going through right now and how we can possibly position our portfolios for the future based on understanding from the past. So while we'd love to kind of do some kind of future gazing here, but I think it's strictly more perspective of what has happened in the past and hence what is more likely to happen in the future. So if you look at July, it is one of the most important lessons that possibly would have been learned by investors. It's like from nowhere, suddenly when the whole world was talking about interest rates going to continue rising for a long while because there is inflation fear. And on July 27, and before that, because people were expecting from the Fed narratives or the market commentary that the Fed might start go moderate on the interest rate kind of rising in that sense. And on July 27, when Fed actually said that they might moderate the future increases from here on and keep inflation data in mind or the economy in mind before taking kind of harsh interest rate rises. From there on, there was a sudden rally in the marketplace across the globe, and India was no different. In fact, if you look at July, we almost got an 8% up on Nifty, and even the mid and small cap indices almost kind of grew by about good 12 and 9% respectively. So, we have to keep in mind that till June, July, everybody was talking about markets are going to go south from there on. And suddenly there is a rally coming in and it's sustaining for first 10 days of August. Though we don't know it's going to sustain from here on or not. What we know for sure is possibly one of the reasons where it has started to do what it has done is simply because investors are now much more prepared about the uncertainties which are lying ahead. So markets doesn't like uncertainty, Alex. We all believe and prefer that we should know what the future is going to be or likely to be in that sense. So initial part of this year, markets were more concerned about whether the interest rates will start to rise soon. If they start to rise soon, how much they will rise by. And the third question was how long it will continue to rise so that people can price the equity risk premiums and so on from there on. So right now, what is very, very clear is interest is going to rise. But given that inflation is peaking out in many markets, we may not see a runaway kind of a rise in interest rates. Hence, possibly there is a risk on environment which is coming back in the marketplace today. And as a July rally there.
Absolutely. I think that sums up quite a bit. But speaking about markets not liking uncertainty, I guess to a certain extent you can say that whatever had to go wrong in 2022 did indeed go wrong, right? So what are the key events that you've looked at that have been quite seismic in nature? One obviously is the war in Ukraine.
Yeah, so while at ET Money we believe more of looking at historical data and kind of trying to understand and learn from that, Alex. So what we've looked upon is not really that what kind of situation we can kind of relate it to in terms of war. What we can relate to is every event in marketplace, be it some kind of geopolitical situation or any kind of any specific central bank raising interest rates, or for that matter how world behaves when China announces something on, or for the pandemic. Ultimately, everything translates into some kind of market signals where interest will start to show you something, crude oil price will start to show you something, gold will start to show you something, interest rates and equity risk premium will start to show you something. So if you can make sense of this data, ultimately it can be modeled into some kind of math, and you can learn from past and see how you can approach investing in future. So what we actually looked at, the biggest fear that all of us in the marketplace today have, not just for investing but also for our futures as individuals, is about what kind of cost of living that we're going to kind of increase in cost of living that we're going to see going forward. And one of the kind of main kind of role play which cost of living in life has is inflation. And of course, inflation governs interest rates. So both these things have been hogging the limelight for most part of 2022. So we looked upon that, how does really interest rates behave in marketplaces, and we modeled and looked upon how kind of government securities as a risk-free instrument in that sense, if we were to consider as one, what kind of interest rate yields this has seen in the past 20 years. And we model based on repo rate, ultimately, because central bank decides the repo rate, and repo rate becomes a guiding point what kind of GSEC rates you would see. And of course, markets are intelligent, markets are always ahead of everybody else. So markets typically tend to price the interest rate hikes much before central banks start doing it. We've seen that in US, we've seen it right now in India as well, where if we look at the relationship between repo rate and GSEC rate, 10-year GSEC yield, you would see that typically the ratio is 1.2. That means the GSEC rates are about 20% higher than the repo rate. And if you look at 2022, it became almost 1.8 times. That means almost 80% higher. So when repo was about 4, I think GSEC was inching towards 7 percentage points. And before even the first policy rate came in, I think the 10-year GSEC was showing about 7.6% interest rate, whereas repo was just about 4. And now, while repo has gone to 5.4, the GSEC rates are 7.2. Now, why does this happening? It's happening because the long-term relationship between repo and GSEC yields is about 1.2x. And typically, even if there is a kind of big spread between repo and GSEC, it starts to narrow down only in scenarios where inflation is peaking out, and the future interest rate hikes may not be in the offing as much as people predicted. So what we are seeing right now is we are seeing a moderation already in the GSEC rates, and hence the risk-free return, while it has fallen down, it is not fallen by as much as people who like to be, where all equity portfolio will make sense. So we believe that as of now, while the inflation fears have not gone off in the marketplace, the interest rates cycle is not ended. It will continue to rise for some more time, but we don't expect or history doesn't tell us that there is going to be a runaway rise in GSEC rates from here on.
Fair point. So one answer, I guess, or one question that has led to volatility, we're nearing the possibility of having an answer, which is how far will interest rates go from this point? And you pointed out at the longer end of the spectrum, if you're talking about 7.2, 7.3 on the 10-year benchmark, a lot of the people that we've spoken to on this show as well have pointed out they're not expecting the 10-year to go much higher than what it is right now, maybe 20, 25 basis points on the upside based on whether there's going to be additional hikes going forward. The other question, of course, is on inflation and on central bank action, right? But that's not going to be just here, Santosh. It's also something that will play out in the US. And of course, we'll get more data in the near term. But chances are that they will continue to be aggressive, right, on inflation. What is the implication then for the rest of the world?
Yeah, so we can't, I think that the unknown over here is how Fed behaves from here on, Alex. Of course, geopolitical situation is not yet stabilized because of Ukraine and Russia war yet. So, I think global events will continue to guide how our interest rates look like. All we're trying to say is that there is definitely the fear of inflation, which was making us all believe that the rates will rise up and continue to rise for a long time to come. That may not materialize unless the situation worsens. And as Fed has indicated in the latest monetary policy at their end on July 27, that it may go it possibly sees that it might go moderate in terms of the hike action from here on. And if that happens, then we may see a kind of a moderate rise in interest rates from here. But if it all doesn't happen, that US Fed continues to raise interest rates at the price or at the rate that we indicated earlier on, even at the cost of recession, then RBI may continue to play the ball in that. So simply because it starts to affect rupee, USD relationship in that sense. The rupee continues to depreciate, and if rupee continue to depreciate, then we basically end up importing inflation. And if inflation today is peaking out, then because of the kind of depreciation rupee, if inflation starts to come back in the country, RBI will again act on it and try to prevent the rupee depreciation from a level. So we believe that Fed is an unknown here, and Fed may kind of control our own policy actions here from here on. But we also have to look at the the entire gloom and doom situation which was there towards the beginning of the year may not play out because the valuations have become closer to long-term averages. So if you look at 1 year ago, the trailing Sensex P was in the region of 26, 28, if I believe. Right now, that is looking like trailing as almost 22 today. So while the markets have only corrected about 7 percentage point, if I look at today's returns in that sense, we possibly have corrected close to 18-19% on the valuation side. If you look at the valuation correction today is far higher because the EPS growth has been quite strong in the markets. So while the earnings season right now is pretty mixed, and we may not be able to forecast very accurately what kind of earnings we're going to see from here on. But what it is looking like is it is not an end of the world situation where the risk to earnings is far higher. I think the earnings are going to be kind of mixed, continue for depending on the sectors here. And if that continues, then the valuation kind of levels may continue to be on the fairer side or towards long-term average. And that's where we need to possibly decide as investors how we want to position our portfolios given the situations which we are seeing on interest rate side and on the valuation side.
One more point on the equity markets and on valuations, on earnings per se, before we get on to what strategy an investor should have going forward. You pointed out that the valuations seemingly more comfortable now than they have been in the past. And of course, that froth that emerged post the pandemic rally that we saw, a lot of people predicted that had to subside just a little bit. And that, I guess, to a certain extent has happened. But going forward, based on the trends that we're seeing, would it be fair to say at least that Indian industry is likely to be much more resilient than other parts of the globe, especially as compared to more developed markets like Europe, like the US, where demand slowdown and recession seems to be pretty much on the cards?
I wish I knew the answer, Alex, on that side. But if you look at the factors which basically govern the consumer confidence in the country, I think we are not yet past the stage where the fear of inflation has gone away from the talk of the common man. I think it is pretty much alive at this point of time. Of course, what we are seeing as a good news is inflation is peaking out, and the credit cycle or the growth in credit cycle from the banking side is actually showing signs of promise. And of course, the NPA problems, which was possibly a big fear that everybody had, is not as much as it used to be about a year ago. So I think on that side, we are well placed. It's all about how we react to the slowdown in the US on our IT export side, or for that matter, how the Russia-Ukraine situation impacts or continues to impact the oil for us. It all going to be as factors going to control how Indian economy continues to grow from here. But as a standalone, I think as we are seeing from the flows, the fire flows have been pretty strong for last 1 month. India is one of the kind of largest beneficiaries of emerging market flows which are coming into picture. I think we are also beneficiaries of the flows because the movement away from China in that sense. So I think there are a lot of good things going for India. How it impacts our earnings going forward doesn't look like on a negative side, at least from past data as well as current data. We need to discover how it looks like, and hence I think it makes sense to not go overboard completely onto equities, simply because there is risk on the horizon, may not be in India in isolation, but across the globe.
Yeah, that brings me to the final point, which is that it doesn't make sense, Santosh, to time the market, because like you pointed out, July has been a great month for the equity markets. You've probably seen, if you've stayed invested, then across the board you're likely to have seen green on the screen, right? But how should you position yourself going forward? You can't ignore the overarching scenario, which is the possibility of a recession in US, the possibility of a recession in Europe. So how should you position yourself? Based on interest rates also, where possibly nearing the peak, some people talking about another 25 to 35 basis points by the Reserve Bank of India. But then given that scenario, how should you approach your investing?
Yeah, so we maintained for last almost a year or so at ET Money, Alex, and even for our investment advisory service in the name of ET Money Genius, we've actually always since February almost we maintained more of a very balanced allocation to high growth strategies that we offer to long-term equity investors. So even if I know one is actually having a long-term view, there is always a sense that should you be buying at every level? And I think at ET Money, we believe that not every level is supposed to be bought. So today, when the risk-free rate in the marketplace is almost inching towards 7.5. In fact, there are FDs by reputed NBFCs in the marketplace which are willing to give up to 7.5 even for non-senior citizens for up to 3 to 4 years of investments. And there is FDs rates which are kind of catching up again. You can make decent amount of real return in your debt mutual fund investments, and kind of connect this entire thing with the uncertainty of global economies, headwinds which we may face right now, or for that matter, how the oil and interest rate react in the marketplace. It doesn't look like it is a conducive environment to go all in equity, even if you're long-term investors, is how we at ET Money believe. And hence we recommend like you should maintain a balanced approach to your investments right now. So if you're somebody who is typically 80, 90, 100% into equities, typically should basically maintain about 65, 70 kind of allocation instead of going all in. And if you are somebody who's always maintain about 60, 70, 75 kind of allocation towards equity, which should pare down towards 50, because the fact is you're making risk-free return and in real terms of 7.5% in government securities, which governs a lot of debt or fixed income kind of investment instruments returns. So going balance is far more better choice, and making a conscious choice of risk management in your portfolio, because protecting the returns earned over last 2 years is also important duty that all of us as investors have. If because being all equity, we lose the gains that we made over last 1 year or last 2 years, then all this comes to naught. And I think for that reason, we would recommend maintaining a balanced stance, irrespective of what kind of investors you are.
Fantastic. I think that sums it up. Thank you, Santosh, for what has been an insightful conversation, and pleasure as always speaking with you.
Thanks, Alex.